What caught my attention this week wasn't just the headlines everyone was busy reacting to, it was the reaction beneath the surface. While the spotlight stayed fixed on the legal shockwave coming out of the Supreme Court decision that struck down the emergency tariff framework used by Donald Trump, the real story quietly unfolded in silver. On the surface, the ruling looked like a policy shift. Markets initially interpreted it as destabilizing. Silver dropped sharply toward the 79.80 area almost immediately after the news broke. That reaction made sense. Uncertainty always hits fast. But what happened next mattered far more than the drop itself. Within the same trading session, buyers stepped in aggressively and drove the price right back up toward 84. That kind of recovery is not noise. It's not casual buying. It's a signal. Markets don't just move based on headlines. They reveal conviction through behavior. When an asset shrugs off negative news and reverses strongly in real time, it suggests there is a layer of demand sitting underneath that most people are not watching. And at the same time this was happening, gold quietly closed the week at 5,100. Not an intraday spike, not a temporary surge, but a full weekly close at that level. That distinction matters more than most realize. Intraday highs can be emotional bursts. Weekly closes reflect sustained positioning. So while public attention was locked onto politics, metals were quietly communicating something else. To understand why this matters, we have to look beyond price and into structure. The vault system tied to the COMEX continues to show persistent drawdowns in registered silver, the category that represents metal actually available for delivery against futures contracts. Over the past month alone, registered inventory declined by over 50 million ounces. That's more than a 12% reduction in just 30 days. Let that sink in for a moment. This isn't theoretical supply. This is metal leaving vaults. On a single recent reporting day, another 1.4 million ounces disappeared across multiple custodians simultaneously. That's not retail demand. That's not coin collectors. That's large-scale withdrawal. When we compare the remaining registered inventory against open interest, the number of contracts that could theoretically demand delivery, the ratio now sits around 0.4. In plain terms, there is only a fraction of physical silver available relative to the claims on it. This is publicly reported data, updated daily. Anyone can check it. Now connect that structural tightness with what the court ruling actually introduced into the macro environment. By invalidating the emergency tariff mechanism, the ruling opened the door to potential refund exposure that could reach into the hundreds of billions of dollars. If refunds are pursued legally and successfully, that creates a gap in government revenue, a gap that must be filled, which usually means borrowing. And increased borrowing tends to place upward pressure on Treasury yields, especially at a time when debt levels are already stretched. At the same time, removing broad tariffs can ease certain inflationary pressures over the longer term. So now we have two opposing forces introduced simultaneously, potential fiscal strain pushing yields upward and trade relief pulling inflation expectations downward. Markets don't like conflicting signals, and when clarity disappears, capital often moves toward assets perceived as being outside policy risk. That's where metals enter the picture. Despite the ruling, alternative legal channels for trade restrictions still exist and remain in play. Mechanisms tied to national security and trade fairness are already established pathways. So the direction of policy hasn't truly vanished. It has shifted form. And uncertainty that changes shape is still uncertainty. Silver's response reflected that reality. The initial sell-off didn't evolve into sustained weakness. Instead, it was absorbed rapidly. A market that collapses on bad news is fragile. A market that absorbs bad news and reverses is resilient. And right now, resilience is exactly what silver is showing. But the deeper story doesn't end with vault drawdowns or policy shifts. It expands into forward projections that are beginning to outline something much larger. A new forecast from UBS suggests that by 2026, the global silver market could face a deficit approaching 300 million ounces. To put that into perspective, global annual mine production sits around 800 million ounces. So this projected shortfall would represent nearly 40% of total yearly output. That wouldn't be a minor imbalance. It would be structural, and it would mark the sixth consecutive year of deficit conditions in the silver market. Even more importantly, this projected gap isn't stable. It's expanding. The 2026 estimate is more than double the previous year's imbalance. That suggests compounding pressure. Stockpiles above ground have already been steadily declining. Industrial demand tied to technology, electrification, and renewable infrastructure continues to grow. Supply expansion, meanwhile, tends to lag because mining capacity cannot be scaled quickly. This isn't speculation, it's a pattern built on multi-year data. At the same time, silver shows tightening availability. Gold continues reinforcing the broader narrative. Closing the week above 5 in 100 marks a historic moment, not because it's the highest price ever touched, but because it represents sustained acceptance at elevated levels. Weekly closes are where conviction shows up. And conviction is what transforms temporary rallies into long-term repricing. Of course, there are counterforces worth acknowledging. A strengthening dollar can create headwinds for metals priced in USD. If trade tensions resolve faster than expected through alternative channels, some institutional capital could rotate back toward risk assets. Short-term profit-taking is also possible after sharp intraday reversals like silver's bounce from the 79s back to the mid-80s. And forecasts, even from major institutions, are still projections, not guarantees. Supply responses can emerge, demand cycles can shift, but certain realities are already observable. Vault inventories are declining in real time. Structural deficits are being forecast by major financial institutions. Gold is holding historically high weekly closes. Silver is demonstrating demand strength even in the face of negative macro headlines. These are not isolated data points. They are interconnected signals. They suggest a market environment where confidence in traditional stability mechanisms is being quietly reassessed. Heading into the coming weeks, the key variable to watch will be how trade policy evolves through alternative legal frameworks. The uncertainty hasn't disappeared. It has simply changed channels, and every time uncertainty persists, metals tend to find relevance. The vault drain is measurable, the projected deficit is documented, the price behavior is observable. None of this requires belief, only verification. And the pattern that emerges is not one of hype, but of gradual structural tightening meeting shifting macro policy. That intersection is where the real story lives. I'm Sopia, and here on Global Pulse, my goal is simple: to walk you through what the data is quietly revealing before the headlines catch up.